Welcome back to our chart pattern series. In the previous episodes, we explored triangle patterns. In this episode, part 4, we're moving into one of the simplest, yet most reliable continuation setups, the rectangle pattern. Let's break down how it forms, why it works, and how you can use it to improve your trading decisions. Let's move on to the fourth category of our patterns, the rectangle formation. A rectangle is a classical chart pattern formed by horizontal lines representing important support and resistance. It's a continuation pattern that creates a trading range during a pause in the existing market trend. It's easy to identify because it has at least two equal highs and two equal lows. Connect those highs and lows, and you'll get two parallel lines, the top and the bottom of the rectangle. A rectangle formation shows a period of indecision between buyers and sellers. Think of it as a boxing ring. Both sides are throwing punches, but neither has clear dominance over the other. Rectangles are also called trading ranges, congestion areas, or consolidation zones. Because we're focusing on continuation patterns, we expect the price to continue in the direction of the existing trend after a breakout. There are two main types of rectangles. Top rectangles. These form during an uptrend. When price breaks out above the rectangle, it often signals the continuation of the uptrend. Bottom rectangles. These form during a downtrend. When price breaks down below the rectangle, it signals the continuation of the downtrend. Keep in mind, rectangle patterns can also act as reversal formations. In those cases, they're often called double tops, triple tops, double bottoms, or triple bottoms, depending on how many times price tests the support or resistance before reversing. When the price tests the support levels 2 or 3 times and then reverses upward, it creates uncertainty. To truly understand what the rectangle pattern will do, you have to wait for the breakout. If you try to anticipate the move and enter too early, you're basically trading noise, a confusing piece of price action. My advice is simple. Wait for the real breakout first, then decide whether you'll trade with the trend or against it. In short, to identify a rectangle pattern, look for a trending market followed by a period of consolidation. At least two highs and two lows should be roughly horizontal. This behavior shows that price is locked inside a box. The top rectangle appears during an uptrend. Here, you want to watch for a breakout through the top level of the pattern. Once price breaks above resistance, it confirms that the bullish move is resuming, and traders can enter long positions. The bottom rectangle is the opposite. It appears during a downtrend. To confirm the pattern, price must break the lower support level. Once price breaks below support, it signals a continuation of the bearish trend, and traders can enter short positions. So, how do you trade the rectangle pattern? If you're an aggressive trader seeking the best possible entry price, you can enter a long trade on a top rectangle as soon as price breaks above resistance. The downside is that this can turn into a false breakout and stop you out. The next approach is more conservative. We will wait for the breakout candle to close above the resistance level. Most of the time, this method reduces the likelihood of getting caught in false breakouts. The only limitation is that if the breakout happens with strong momentum, you'll have to enter at a higher price. Now, what happens if you miss the breakout completely? The best option is to wait for a pullback or a retest at the new support level, then take your long entry from there. If there is no retest, don't chase the price. Just skip the trade. There will always be better setups ahead. Always confirm that volumes are increasing during the breakout. Higher volume signals strong buying interest. You can also check indicators like MACD or RSI to strengthen your analysis. For bearish breakdowns, the same principle applies to the bottom rectangle pattern. Your primary instinct should be to look for short trades. 3 main entry styles are possible here. Aggressive entry, enter immediately on the breakdown. Conservative entry, wait for the breakdown candle to close below the support level. Pullback, retest entry. If you miss the breakdown, wait for the price to retest the broken level before entering. Ultimately, the decision depends on your trading style, aggressive or conservative. In every case, Validate the breakout with volumes and momentum-based indicators to ensure the market truly supports the move. Now let's learn how to set a proper stop loss. A well-placed stop loss protects your capital without disrupting your risk management. When you see a rectangle breakout, measure the total distance between the support and resistance lines. Then place your stop loss at the midpoint of that width. This applies to both top rectangles and bottom rectangles. By doing so, you know exactly how much risk you're taking. The maximum you can lose on the trade equals half the width of the pattern. Why is this important? Because before the trend continues, shakeouts are common. If you keep your stop loss right at the breakout point or just below it, smart money can easily trigger your stop before pushing the trend in their favor. Placing it at the midpoint gives your trade room to breathe while still controlling risk. Now let's talk about exiting a profitable trade. While trading rectangle patterns, the minimum target is usually equal to the full width of the rectangle. In other words, once a breakout occurs, you should plan to stay in your trade at least until the price moves by the same amount as the height of the pattern. This implies that the width between the support and resistance of the rectangle should be projected on the chart from the breakout moment. Because the stop loss is at the middle point of the rectangle range, it means that the size of the target is twice the stop loss. This makes the reward to risk ratio 2-to-1. Until this move is exhausted, you can use the trailing stop loss method to ride the trend. Yes, you're right. A suitable period of moving averages can help you with this. There is another way traders can use rectangle patterns. If the width of the pattern is very high, you can sell at the support level and buy at the resistance level. This can be used as an intraday or swing strategy if it provides a decent reward to risk ratio. If you have a top rectangle pattern, then you can take a long entry from the bottom support level and keep your stop loss below the lowest wick or candle during consolidation. Your target will clearly be at the resistance level. Similarly, for a bottom rectangle pattern, when the price comes below the top resistance level, then you can look for short trades. Place your stop loss above the highest wick or candle during consolidation. The target can be at the lower support level. Sometimes, if a breakout occurs, this method provides you with the best possible price before the breakout. Before you go, if you found this breakdown on rectangle patterns useful, make sure to hit like, subscribe to the channel, and turn on notifications so you don't miss the next part in our continuation patterns series. Share this video with your trading friends. It helps the channel grow and lets us keep bringing you more powerful trading strategies.